So today we're joined by Sean Farrell, our head of digital assets here at FS Insight. And Sean, last week's Crypto Weekly report might be one of my favorites because crypto is such a new asset. It's a digital asset, and watching how it plays in traditional markets is interesting to be on the sidelines to watch. And just last week, we had two very unique trading days, and there were some unique observations made that could have immediate and long-term implications. So can you provide a little insight on that?
Hey everyone. Yeah, just want to run through a couple of quick topics. These are issues we raised in our last Crypto Weekly, but just want to hammer home these concepts because as they start to evolve, they become more important. One topic that has emerged over the past couple of quarters as NASDAQ has continued to breach newer lows, seemingly on a weekly basis, while crypto has remained relatively steadfast, hasn't necessarily challenged its lows from back in June. Obviously, a lot of that had to do with the cascading liquidation throughout the market and the fact that a lot of selling might have been pulled forward with that event. However, an interesting nuance has presented itself recently where had the markets start to move not just based on changes in global liquidity necessarily, but start to move, equities have started to move based on earnings misses, earnings beats, and any revised estimates that come as a result. And something that has started to emerged pattern is that, frankly, it seems like to us that crypto is not as reactionary to earnings as it is to, say, changes in rates or changes in QE versus QT. And that's important. That's important for risk management today, and it's important for thinking about how to construct a portfolio moving forward, depending on what kind of economic regime we're moving into. Obviously, we presented a few examples of trading sessions over the past couple of weeks. We see last week, there were several earnings beats. I think perhaps it was the bank earnings, presented a rosier picture for the U.S. economy than I think a lot of people had anticipated. And so we actually saw the S&P 500 as well as the NASDAQ up on the day. Interestingly, though, given the rosy earnings, whether it's directly related or tangential, rates spiked. And when rates spiked, crypto, we're showing the total crypto market cap here and with the yellow line, that actually went down. So despite us focusing on a correlation between stocks and crypto over the past 12 months or so, we've started to see these intraday decouplings, so to speak. Fast forward to 10/18, we see, the bond market really drove prices that day. Rates spiked quite dramatically in the morning. And as a result, we saw both stocks and crypto kind of succumb to that pressure. So this was a scenario in which, rates were in the driver's seat for asset prices that day. As a result, we saw both crypto and stocks go down. This was a very interesting example, not the following day, but the day after. So this was Thursday. We started out the day with very interesting earnings beats, right? And so we got a very positive response from stocks that morning. They were far outpacing the gains in crypto, which we can see were likely benefiting from falling rates. Come afternoon, we saw rates start to spike. And as a result, both crypto and stock started to go down. So that brings us to the latest example. Yesterday, probably the most obvious example of a divergence in stocks and crypto. We had some pretty interesting tech earnings misses yesterday after close with Microsoft and Google. And we saw NASDAQ dump. NASDAQ plummeted after hours, but Bitcoin and the wider crypto ecosystem was relatively robust. In fact, due to the implicit decline in rates, we actually saw some additional uplift in crypto prices. So this is an interesting dynamic that we're just going to continue to keep an eye on. I think the big takeaways here are, one, from a risk management perspective, save for a scenario in which encounter a crash, everything correlates to one, and all assets sell off, similar to COVID or the '08 great financial crisis. Everything kind of correlated to one, and people sought US dollars. Obviously, in that scenario, we could see a huge wick down. But, if we continue to just trot along and stocks, kind of just bleed as earnings misses start to come out and people have more confidence that the Fed can be less hawkish over the next few quarters, I think it's very reasonable to think that crypto outperforms on a relative basis. Further, this also presents an interesting thinking exercise for how to position portfolios once we move past this tightening cycle. And if we enter a regime in which liquidity remains plentiful, however, there is less growth and earnings are not as robust, then perhaps we see crypto start to soak up a lot of that excess liquidity that otherwise would have gone to these unprofitable tech stocks. This is something we're thinking through and an interesting framework we're starting to apply to our analyses.